Welcome to our first session on market structures. Today, we will be covering the three key phases of the market: bullish, bearish, and consolidation. First, let's talk about the bullish market. In a bullish market, we see an uptrend where prices are consistently making higher highs and higher lows. Next, we have the bearish market. Here, the market is in a downtrend, with prices forming lower highs and lower lows. Finally, we have the consolidation phase. In this phase, the market moves sideways, and prices tend to stay within a defined range without a clear upward or downward trend. Now we're going to discuss market structures and how they can help you understand market trends. First, let's talk about an uptrend. In an uptrend, we see a pattern of higher highs and higher lows. This means that each successive high is higher than the previous high, and each low is also higher than the previous low. This indicates a strong bullish market. Here's what it looks like: higher high, higher low, higher high, higher low. Next, let's discuss a downtrend. In a downtrend, the pattern is the opposite: lower lows and lower highs. Each high is lower than the previous high, and each low is lower than the previous low. This signifies a bearish market. The pattern looks like this: lower low, lower high, lower low, lower high. Now, what about a consolidation market? In a consolidation phase, the market moves sideways, and we are not making significant new highs or lows. This means that the price is trading within a range, and the market is neither bullish nor bearish. During this phase, institutions might be accumulating positions, preparing for the next big move. To summarize, you should concentrate on understanding these three market structures. 1. Uptrend, higher highs and higher lows. 2. Downtrend, lower lows and lower highs. 3. Consolidation. Let's start with the monthly and weekly time frames. These are our largest time frames and provide us with a broad view of the market's direction. Notice how the market is making higher highs and higher lows. We'll highlight these highs and lows with yellow color. This pattern indicates a bullish market, as the price is consistently moving upwards. However, it's important to remember that different time frames can show different trends. Now, let's zoom in on the daily time frame. We'll mark a specific section from our monthly-weekly chart to see how it looks on a daily scale. In the daily time frame, we might see a downside movement, which appears as a bearish trend. Here, the price is making lower highs and lower lows. Let's mark these highs and lows with blue color. Despite the overall bullish trend in the monthly and weekly time frames, the daily time frame shows a bearish trend. This means that while our long-term outlook is bullish, we can still find opportunities for short positions in the daily time frame. Now, by focusing on the move I've encircled here on the monthly and weekly time frames, as you can see, there's a clear move to the upside. This suggests a bullish trend is forming. Now, when we look into the daily time frame, we can observe that the market is showing higher highs and higher lows. This pattern confirms that we are in a bullish trend on the daily chart as well. While on the daily chart, we can see multiple higher highs and higher lows, indicating a strong bullish trend. The weekly chart shows a more subtle move. There, we might only see one or two candles moving to the upside. Now let's talk about how to find the highs and lows on a 4-hour chart when the daily trend is going up. Look at the diagram. When the daily trend is bullish, we see many highs and lows on the 4-hour chart. These points are important to understand how the market moves in this time frame. We can find these points easily by also looking at daily and weekly or monthly charts. The 4-hour chart might look different. I've marked the highs and lows with purple. It might seem complicated, but it actually makes it easier. Seeing these highs and lows helps us find the real swing points. In the market, there are big structures with smaller structures inside them. It's important to understand these layers. In the next video, I'll show you examples with charts to make it clearer. For now, just look at how I marked the highs and lows in these diagrams. It's important to know the market structure before we learn the rest of the strategy. This video is only about finding the market structure. We're not talking about how to buy or sell yet. Remember, knowing the market structure is the most important part of this course. Once you get it, we'll add it to our full strategy. That's it for this video. Stay tuned for the next one, where we will use chart examples. Thanks for watching. Welcome back, traders. This is the second video in our market structure series. Today, we're going to talk about price action, which means how the price moves in the market. I'll be showing you a diagram to explain what an impulse and a correction are and why they matter. First, let's talk about an impulse. An impulse is a strong move in the market. It's a big, quick move in one direction. The price moves sharply up or down, showing a strong trend. Now let's talk about corrections. A correction is a small move in the opposite direction during a bigger trend. Corrections are important because they can help us find good times to buy or sell. Understanding impulses and corrections helps us see market patterns and make better trading choices. Let us imagine the market suddenly drops with lots of momentum, a big move down. After a big drop, we see a correction. During the correction, the market slowly moves up. It's a pause, not a trend change. Once the correction ends, the market often makes another strong move down. Looking at higher time frames helps us see the overall direction of the market and big levels where the price might change. When we combine this with lower time frames, we can find better points to enter and exit trades. This helps us make better trading decisions. Let's look at a weekly chart. First, we see a big drop in price, making a new low. After such a drop, the price usually goes up a bit before dropping again. This small rise is called a pullback, which creates a lower high before the price drops to a new lower low. Right now, the price is slowly moving up. When it reaches a certain level, it will likely drop quickly again. On the weekly chart, this move up looks bullish, but on the daily and 4-hour charts, it will turn bearish, as shown in the diagram. By diving into the monthly chart of GBP/USD to understand its recent movements, as we examine the chart, we notice the creation of new lows and highs. Recently, there has been a significant break of structure to the downside, resulting in the formation of new lows. This was followed by another break of structure, accompanied by a strong, impulsive move downward. To better visualize this, I have marked the significant highs and lows on the chart with blue color. These markings help us identify key areas to watch as we wait for the market to return to our zones of interest. Keep in mind that the price will likely move slowly towards these zones, reflecting the correction phase we've discussed previously. Here, you can see the break of structure clearly marked on the chart, indicating where the market dynamics shifted. Now let's look at the weekly chart to see how the correction phase works. Watch how it makes highs and lows as it moves slowly towards our point of interest. See how it broke the previous high and then continued to rise slowly. As I show you the highs and lows, notice how it reaches our point of interest. At this stage, it will start taking out all the highs and lows created during the correction phase. Now, let's focus on how it breaks these levels. Pay close attention to how it drops quickly and aggressively. You can see that we have hit a new low, breaking the previous lows and creating a new lower low. This part of the analysis is important because it shows the market's behavior during a correction phase. By understanding these movements, we can better predict future price actions and make informed trading decisions. Now, I will show you how we can catch the moves when the market is in a correction phase. Let's jump into the daily time frame and mark our points of interest. We'll focus on identifying both short-term and long-term buys as we navigate through smaller structures within the daily time frame. First, we need to mark our point of interest. We're looking for how we can catch the move to the upside. To do this, we'll use the Fibonacci tool to identify the imbalance area at the 50% or 79% level of the Fibonacci retracement. You'll learn more about this in upcoming videos. For now, we need a pullback to create another higher low. This setup will help us identify a strong buying opportunity. I showed you how to find point of interest using a rectangle box. This will help you understand how prices move in the market. We talked about how prices goes up and down, and how to spot important patterns like highs and lows, and when the market makes higher highs and higher lows or lower highs and lower lows. You'll learn the full strategy in the next videos. But for now, let's focus on finding these key points. As I mentioned, the weekly time frame is moving up during the correction phase, creating higher highs and higher lows. On the daily time frame, we can see the price moving slowly toward our weekly point of interest. Once the price taps into the weekly area, it often falls aggressively from this point. This is where institutional or banks come in with huge volume, causing the price to drop and create the next low. Now, let's mark the highs and lows on the daily time frame using yellow color, and where we can find opportunities to buy up to the weekly point of interest and sell from there. Remember, buys are for the short term, and sells are for the long term. As you can see, when we move to smaller time frames, everything looks messy and confusing. Personally, I prefer to analyze charts on higher time frames because it works better for me. I enter trades on lower time frames. This strategy works on all time frames. Supply and demand is a very strong strategy, and understanding market structure is key. Focus on market structure first. Learn how price moves with impulse and correction. Use a combination of time frames. Practice in the live market, and you'll see how effective it is once you understand market structure. That's all for the second video. Understanding price range is crucial because when you buy, you aim for a good deal, and when you sell, you aim for a profitable price point. Now, let's talk about a powerful tool we love to use, the Fibonacci retracement. This tool helps us analyze potential price retracements or reversals in the market, aiding in making informed trading decisions. Let's explore how to leverage Fibonacci retracement to enhance your trading strategy, as we have a unique approach to using Fibonacci. While many traders focus on levels like 61%, we keep it simple by highlighting the 50% mark. This level often serves as a significant point of interest in the market, making it easier for us to identify potential trading opportunities. Now let's see how this simple yet effective strategy can work wonders for your trading. In our approach, we focus solely on highlighting the 50% mark. This level represents fair value in the market. Anything above this point is considered the premium area, where prices are relatively higher, and anything below is termed the discount area, where prices are relatively lower. Understanding these zones helps us gauge market sentiment and identify potential trading opportunities. Let's delve deeper into how this strategy can give you an edge in your trading endeavors. This way of using Fibonacci is called price range analysis. Remember, we have fair value, discount area, and premium area. Stuff in the premium area is good for selling, and stuff in the discount area is good for buying or going long. You want to buy cheap in the discount area and sell for more in the premium area. Fair value helps us know where these areas are. Now, I'm going to reveal my secret key levels of Fibonacci I use are the area between 79 and 100 level. These are the prime areas for buying or selling in the market. Let's take a look at the chart to see how these levels operate and why they're so crucial for making effective trading decisions. Now, let's uncover how to pinpoint buying opportunities within the discount area. Watch closely as I utilize Fibonacci retracement from the market low to high, highlighting the 79% level and the area between 79% and 100%. This zone consistently offers opportunities to identify potential buying opportunities. Now, let's see how to pinpoint selling opportunities within the premium area. Watch closely as I utilize Fibonacci retracement from the market high to low, highlighting again in an opposite direction the 79% level and encircling the area between 79% and 100%. This zone consistently offers opportunities to identify potential selling opportunities. Now let's look at the charts. On this time frame for GBP/USD, you can see the market is in a downtrend, making lower lows and lower highs. First, we'll mark the highs and then the break of structures, or lows, that you can clearly see on the charts. Now watch how I draw the points of interest in our premium zones using Fibonacci. It's important to draw Fibonacci from high to low when we are looking for sell opportunities. This helps us identify the best areas to enter our trades. As you can see, I've placed the Fibonacci tool from the recent high to the recent low. This highlights our premium selling points on the charts. These zones are where we look for price retracements to enter short positions, maximizing our chances of profitable trades. By marking these key levels and understanding market structure, you can better navigate the downtrend and make informed trading decisions. Now let's check how the market looks on the 4-hour time frame. Notice how the market moves down with strong, impulsive moves and then slowly comes back up to our points of interest before falling again. As I mentioned in the last video, this slow movement upward is called the correction phase. Watch as I mark the higher highs and higher lows coming towards our supply area, also known as points of interest. After the market taps into these supply zones, it falls again. This pattern of falling impulsively Correcting to the upside and then falling again is key to understanding market behavior. Let's take one more example by diving into the charts again. This time we'll look at a buying example. As I showed you before, you can mark the supply areas using Fibonacci retracements. Now, let's dive into a bullish example. First, let's mark the low on the chart and identify the break of structure to the upside. Using the Fibonacci retracement from the low to the high, we can pinpoint a better point of interest, or what we can call a perfect demand area. I also identified an order block and marked that specific order block candle, which serves as an ideal point for buys. Notice the beautiful break of structure before this, as well as the pullbacks, with the market coming inside the point of interest and then flying up. Watch closely. Here, I found another order block candle. By using the Fibonacci retracement, I can pinpoint the perfect area for a low-risk buying opportunity. This is the low of the area, below the point of interest. Notice how I've encircled the order block candles with yellow to make them easy to spot. I've also highlighted the highs of these areas with the same color for better visibility. Additionally, I've marked the higher highs and higher lows with black to clearly show the path. This is how it looks on the 4-hour chart. Remember, this video is about understanding price ranges. It doesn't mean you need to buy or sell when the price hits 50% or 79%. It's more about learning how price ranges work. In the next session, we'll talk about imbalances. These are some basics about price ranges. If you have any questions, contact me on Telegram, Instagram, or anywhere else. Be sure to re-watch this video a few times to understand everything. I'm explaining it simply to avoid confusion. Enjoy the course and see you in the next video. This is our 4th video in the series, and today's video will be short because the topic is easy to understand. To understand trading, remember this simple rule. To buy, someone needs to sell. Whether you're buying a currency, a stock, or any asset, there's always someone selling it to you. Now, let's talk about price action. There are 2 types: healthy price action and unhealthy price action. Look at this chart. See how the price goes up? Before it shoots up, check out the first candle with a wick above and the third one with a wick below. The space between them? That's called an imbalance. It means things are a bit out of balance in the market. When you see this, it's not great. It means lots of people want to buy, pushing the price up. Sellers don't have much of a chance. Buyers are pretty much in control. Now, let's look at spotting a market trend going down. Look at the first candle before the drop. Notice the wick below this candle. Then, check out the third candle's wick above it. Mark the area between them. This area marks the beginning of the downward move. It's where the market shows signs of weakness and starts to shift towards a downtrend. Next, observe how the market enters this imbalance area. This is called an healthy price action. It tries to correct itself, but then it drops again impulsively. Now, let's dive into spotting imbalances in the market. Watch closely as I demonstrate how to identify them using these rectangular boxes. Pay close attention because practicing this skill will help you spot opportunities in live markets. Notice how I'm encircling the imbalances within these boxes? Each one represents a moment of imbalance between buyers and sellers. By studying these patterns, you'll develop a keen eye for market dynamics and improve your trading decisions. Remember, practice makes perfect. Keep honing your skills by analyzing live charts, and soon you'll be spotting these imbalances with confidence. Now let's mark a few more examples to help you understand price efficiency and imbalances better. Look closely at the chart and watch the videos a couple of times until you get the strategy. You might wonder why I'm talking about imbalances. It's because we use everything we can to make better trading decisions. If we find a zone with an imbalance, it makes that zone even stronger. You'll also learn about supply and demand, entry points, and other important concepts. Just focus on the chart to see what an imbalance looks like. Prices move from areas where there's too much supply to where there's more demand, and vice versa. When they leave an imbalance, they usually get filled eventually. So prices need to balance out before the next move. Once you've learned all this, you can use the rest of the strategy to make money in the market. Just enjoy the whole course. See you in the next video. Bye. Hey traders, welcome back. Today, we will talk about supply and demand zones, the most interesting and important topic. These are spots where big players like banks do their trading. But remember, I'm not a bank. We'll keep it simple and just call them supply and demand zones instead of order blocks or institutional blocks. These are places where banks are thought to buy or sell in the market. In this video, I will show you how to find these zones on a diagram by mentoring you through and how they can help your trading. Now let's take a look at a bullish market. As you've learned from the first session on market structure, we need to identify the key highs and lows. Look at this diagram. First, let's mark the highs and lows using blue to make it easier on your eyes. As you can see, we've broken the previous structure, which I've indicated with an arrow right here. This occurs just before the significant move to the upside, leading to the formation of a higher high. The demand zone is located at the higher low. This area is our next point of interest for potential market opportunities. Now let's go through the criteria for identifying supply and demand zones. The first criterion is a break of structure. The second is a significant move up or down, and the third is an imbalance. You already know what a break of structure is from our market structure session. A significant move, which reflects price behavior, and imbalances are also familiar concepts. A break of structure is essential because it gives us insight into the market's direction and what the market makers are targeting. For instance, if we consistently see higher highs and higher lows, it indicates a bullish market. This means institutions or banks are driving the market upwards until we eventually see a break to the downside. A significant move, whether up or down, signals strong volume or a substantial push in price, which helps us identify potential supply and demand zone. Now let's focus on what happens when the market pulls back, making lower lows and lower highs. Once it reaches a specific location, let's call it a 4-hour demand zone, the market often starts to print higher highs and higher lows. Let's focus on identifying this demand zone. You can call it a point of interest, area of interest, or location. These terms are interchangeable and refer to the same concept. The same principles apply to a bearish market. If the market is printing lower lows and lower highs, your point of interest, or supply zone, will be at the first lower high. As the market prints these highs and lows, it eventually reaches our supply area before falling again, confirming the bearish trend. Notice how I've marked the lows and highs with the same blue color, and then see how it is leading up to the supply zone, and then see how it falls from the zone. In a bearish market, the supply zone is where you can sell. It's also called a supply zone, point of interest, area of interest, or location. Like in the bullish trend we discussed earlier, it's important to notice the break of structure, which I've marked in the same way here. Trading isn't a quick way to get rich. It takes time and learning, so don't become overly confident too soon. This is just the beginning of your trading journey. In the next video, we'll look at real chart examples. Remember, while trading may seem easy on diagrams, it's actually quite complex. But with consistency, you can succeed. Good luck, and enjoy the content. Bye for now. Welcome back, traders. Today, we're diving into the second part of our supply and demand zones section. In this video, I will show you how to draw supply and demand zones, also known as points of interest or areas of location. We'll go through some chart examples to illustrate these concepts. Let's start with the British Pound US Dollar, GBP USD chart. Now the tools we can use to draw these areas are quite simple. One effective tool is the Gann box. To use the Gann box, you'll need to draw it from the high of the order block candle to the low of the order block candle or low of the order block candle to high of the order block candle. As you can see in the diagram, we will dive into a practical example to see how this works. Alternatively, you can just use the rectangle tool to mark the supply and demand areas. Simply draw the rectangle around the order block candle to highlight the significant zones. Both tools are effective, and the choice depends on your personal preference and trading style. Personally, I use a rectangle box to highlight my supply and demand areas. It looks simple and is easy to see on the chart, making it better for our eyes. Let's dive into a practical example to see how this tool works in real trading scenarios. Now let's jump into the charts on the GBP USD weekly time frame. As you can see, we were trending up here with small pullbacks followed by a big push up again. At the top, that was our last high, which then broke to the downside, creating a downtrend. The sellers took control, kicking the buyers out. See how the market has turned into a bearish trend. We have some recent breaks of structure here, as you can see on the charts I am highlighting. Notice how after every break of structure, the market pulls back and then makes another break of structure. Now let us zoom in and pay attention. I will show you how to mark the supply area in this scenario. After every break of structure, we need to draw the first candle of that move to the downside. This candle is called the order block candle. Watch closely as I mark these zones. Now we will jump into the daily time frame to simplify things and help you understand better. See how simple it looks in the daily time frame. Here, we can find more order blocks. Remember, mastering these concepts is a step-by-step process. Stay patient and focused. Every bit of progress brings you closer to becoming a successful trader. Look closely as I find another order block candle inside the larger structure. Notice how there's another break of structure and one more order block before that break. See how the market moves down, breaks the structure with a huge move to the downside, and then comes back to our supply area before falling again. Notice how it breaks another structure to the downside, then returns to the recent order block candle before falling once more. This is how the supply area is respected across all time frames. Now this is how it looks on the 4-hourly time frame. See how the best moves happen when the price touches the supply area. By catching the counter trend, we can easily catch a 9% move and make good profits in the market. This is how we highlight the supply area. That wraps up our discussion on the supply area. Now, I am going to show you how to find and draw the demand zones on the charts within a bullish trend. As you can see on the chart, the market is moving upwards, printing higher highs and higher lows. Look at this black order block candle. It has not been filled yet, so it will probably get filled in the future. Let's mark this candle as our demand zone. See how the market went up after this candle? This shows that the demand zone is strong and can affect prices later. Now, let's focus on the recent break of structure to the upside. It's important to always pay attention to the most recent break of structure. This big move up left some imbalances that haven't been filled yet. Next, see how I draw our demand zone on the order block candle right before the upward move started. Notice how the market came into this demand zone and then moved up again. This is how we draw our demand zones. Now, by zooming into the daily time frame, notice how clear it appears. Focus on how the weekly break of structure is represented on the daily chart. Observe the order block candle that I have encircled before the break of structure, and I have also encircled the swing high, and I encircled the area. When the price taps into our demand area, this is how it looks on the daily time frame. Now let's dive into the 4-hourly time frame to see what's happening on the 4-hour charts. It's getting interesting. Let me remove these red lines first. Now pay attention to the diagram and see how I am highlighting these breaks of structure to the upside. Notice the huge imbalances there, and observe how the price has come down only to go up again and break the high aggressively. See how it has broken the high after coming down. This coming down is known as a pullback to our demand area. Look at the path I highlighted with red color because it will be better for your eyes. Now let's take a closer look at how we're highlighting the demand zone. Notice how the price came down into this area. This is an important indication that we can place a trade within this demand zone. See how I've highlighted the order block candle here. The price tapped into our demand zone and has since moved up from there. This strategy is effective across all time frames, whether you're trading on a lower or higher time frame. Now, let's take a second example. See how the market has broken the structure to the upside. Watch as I draw the demand zone on the order block candle. Notice how the market pushed up and then retraced into the demand zone. After tapping into the demand zone, the market moved up again. I've encircled this area for clarity. Now look at this small area where I found 2 break of structure patterns to the upside. See how I draw a demand zone within this structure and another demand zone just before it. Notice how the market has broken the structure repeatedly and then retraced back into our demand zones. Demand zones are the best areas for buying, just as supply zones are optimal for selling. Now, let's take a look at the 1-hour time frame to see how it appears. On the 1-hour chart, you can identify even more demand and supply zones. This illustrates how supply and demand work in trading. Make sure to re-watch this video a few more times until you fully understand these concepts. I hope you found value in this Lessons Academy. Good luck and goodbye. Welcome back to the very interesting session called Liquidity Concepts. Today we will discuss liquidity because, as you guys know, the market is driven by liquidity. Without liquidity, the market doesn't move. Liquidity refers to how easily an asset can be bought or sold in the market without affecting its price. As you guys know, we have retail patterns, as you can see on the diagram. People often go to Google and search for these patterns, and they find double bottoms, triple bottoms, double tops, triple tops, and all of these patterns. You can find them on sites like babypips.com or learn them from many other sources out there. However, these patterns usually do not work in real trading. They are often not useful and can be misleading in actual market conditions. Before we go to the example, I want you to know something important. When someone wins in Forex, someone else is losing. The money lost goes into a big pool. The winners take their profits from this pool. The tool used to highlight the zones of liquidity areas in Forex trading is this one, as shown in the diagram. Let us take a bearish example. As the market is printing lower lows and lower highs, we see a double bottom below where the liquidity is sitting, as highlighted in the diagram. Our goal is to target that liquidity. As we know, our strategy is supply and demand. You can see on the diagram that we have a supply zone and another supply zone below that where the price has tapped now. We are looking for shorts, or we can say sells. The market is still in a bearish structure. There is nice liquidity below, as I have highlighted. So we are looking for shorts from the second supply area. After the price taps into the supply zone, it will take the liquidity sitting below. After the price takes the liquidity, this liquidity area will become a break of structure to the downside. We then have to wait for the market to complete the correction phase. Once the market comes into the new supply zone created, and after tapping that supply zone, the market will fall again and break the new low once more. Now let us take a bullish example. The market is printing higher highs and higher lows with two break of structures to the upside and a double top on the top where the liquidity is sitting. Our goal is to target that liquidity, just like I showed in the bearish example. Again, as our strategy is to trade supply and demand, you can see on the diagram that we have a demand zone here and another demand zone above that where the price has tapped now. Here, we are looking for longs, or we can say buys. The market is in a bullish trend, and we have nice liquidity to target. So, we are looking for longs from the second demand zone to take off the liquidity sitting there. After the price takes the liquidity, this liquidity area will become a break of structure to the upside. After that, we have to wait for the market to complete the correction phase. Then the market will come into our new demand area. After tapping into that new demand area, the price will go higher and break the new high. This is how liquidity works in trading. Stay persistent and dedicated. Every step you take in understanding these concepts brings you closer to mastering trading. Remember, every great trader started where you are now. Keep refining your skills, stay disciplined, and success will follow. Keep up the hard work, you're on the right path. Then we have something very interesting. Consolidation in the middle of a bullish trend. The market has pushed up with huge imbalances and a break of structure. After making the high, the market starts moving sideways, manipulating retail traders. The key is to wait patiently for the market to tap into our demand zone. This consolidation between our demand zone and the high is known as a liquidity pool, where many retail traders lose their money. We should take our trade when the market taps into our demand area, and then it will break the high or go higher. Now let's talk about the bearish scenario, consolidation in a bearish trend. The market has broken structure to the downside and left huge imbalances. After making the low, the market starts moving sideways, manipulating retail traders. The key is to wait patiently for the market to tap into our supply area. This consolidation between the low and the supply area is called a liquidity pool, where many traders lose their money. We should wait for the market to tap into our supply area, and then it will break the low, which is our target, and could go even lower. These two concepts are called liquidity in consolidation or sideways market. Now let's jump to relative equal highs and relative equal lows. This means when the price creates almost a double top, but not quite, and then comes down as shown in the first diagram. Notice at the top where I've highlighted the equal highs, which means liquidity is still sitting there. The same concept applies to relative equal lows in the second diagram. See how I've highlighted the relative equal lows in the second diagram. In both of these scenarios, relative equal highs and relative equal lows, the price should not break the first high in the first diagram and the first low in the second diagram. These are encircled in both diagrams to help you understand better. This was just an introduction to liquidity on diagrams. We will go through liquidity concepts in more detail later. For now, we've covered the bullish example, the bearish example, consolidation, double bottoms, double tops, relative equal highs, and relative equal lows. In the next videos, we will look at good examples and discuss more liquidity concepts, including trend lines and more. Study hard and enjoy the content. Bye. Welcome back to the second part of our session on liquidity concepts. This will be a very short video focusing on trendline liquidity. In the last video, we discussed equal lows and equal highs, liquidity pools, relative equal highs, and relative equal lows. Now I will show you a diagram to illustrate what trendline liquidity looks like. On a smaller time frame, let's take the 1-hour chart as an example. The market is moving up, printing higher highs and higher lows. During the correction phase, it moves towards a higher time frame supply area, or what we can call an area of interest, AOI, or point of interest, POI. From the daily supply zone or higher time frame supply area, we have more confluence to take a sell position because there is a lot of liquidity sitting below in the form of trendline liquidity. As we trade supply and demand, our goal is to look for sell opportunities from the higher time frame supply area. After the market taps into the daily supply area, we will see changes in structure to the downside on the 1-hour or lower time frame. The market will move down, then retrace slightly upwards, creating a break in structure to the downside. This will form a lower time frame supply zone. After breaking the structure to the downside, the market will retrace to our 1-hour supply area and then fall to take out the trendline liquidity we've identified. Our goal is to target all the liquidity down to the low of our zone. Even the low on the diagram is our final target. Now focus on this diagram. I have highlighted everything you need to know. Note down all the elements I've explained in the diagram for your practice. Look at how I've highlighted each component. Higher time frame POI or supply area. Lower time frame POI or supply area trendline liquidity at the bottom. And the notes on the right side of the diagram trendline liquidity refers to the encircled parts on the diagram where retail traders typically buy. These encircled areas are also called trendline liquidity zones. The key is to target these buying areas of retail traders. To better understand this concept, focus on the encircled regions on the trend lines in the diagram. Remember, success is not final, failure is not fatal. It is the courage to continue that counts. Keep pushing forward, and your dedication will lead to success. Let's take a second example. On a smaller time frame, such as the 1-hour chart, we observe the market moving down, printing lower lows and lower highs. During the correction phase, the market moves towards a higher time frame demand area, also known as an area of interest, AOI, or point of interest, POI. From the daily demand zone or higher time frame demand area, we have more confluence to take a buy position because there is a lot of liquidity sitting above in the form of trend line liquidity. So now our goal is to look for buy opportunities from the higher time frame demand area. Once the market taps into the daily demand area, we'll observe changes in structure to the upside on the 1-hour or lower time frame. The market will move up, then retrace slightly, creating a break in structure to the upside. This will form a lower time frame demand zone. After breaking the structure to the upside, the market will retrace to our 1-hour demand area and then move up to take out the trend line liquidity we've identified. Our goal is to target all the liquidity up to the high of our zone. The high on the diagram represents our final target. Now focus on this diagram. I have highlighted everything you need to know. Note down all the elements I've explained in the diagram for your practice. Look at how I've highlighted each component. Higher time frame POI or demand area, lower time frame POI or demand area, trend line liquidity on the top, the notes on the right side of the diagram. Trend line liquidity refers to the encircled parts on the diagram where retail traders typically sell. These encircled areas are also known as trend line liquidity zones. The key is to target these selling areas of retail traders. To better understand this concept, focus on the encircled regions on the trend lines in the diagram. So yeah, you just need to know one major thing. If something looks easy on the charts, it likely won't work. That's why retail traders lose money while we are winning. Simplicity is one thing, but easy is something completely different. We need to work on simple things, not easy ones. Our strategy is simple, but it requires a lot of practice. The The concepts you learned in this video and the last video are simple to spot on the charts, but not necessarily easy. In the next video, I will show you chart examples. Enjoy the content and practice it as many times as you can on live charts. See you in the next videos. Welcome back to the third part of the liquidity concept series. This time, we don't have diagrams to show. Instead, let's jump directly to the charts and see these concepts in action. Now let us focus on the recent move to the upside on GBP/JPY. Notice how I will encircle the low before the upward move started, and see we have a clean break of structure to the upside. Observe how I've highlighted the low of our zone and now encircled the high of our zone, as shown on the chart. As we learned in the price range session, I will now use the Fibonacci retracement tool to find the best discount area, or we can say the demand area. Now, observe the imbalances, which are in the form of liquidity, as I have highlighted. I will encircle this area to make it clearer for you. This area represents trendline liquidity, as you learned in the last video. The market will likely enter a correction phase until it reaches our demand zone, taking all the liquidity along the way. As I'm showing on the chart, the price will come down, tapping into our demand area. After this, the price will create liquidity to the upside. This is what we need to target from our demand zone. Notice how I have highlighted the trendline liquidity on the red path I created. Now let us see how the market reacts to our path. Watch how it taps into our demand area and creates liquidity to the upside. Always remember, the only limit to our realization of tomorrow is our doubts of today. Believe in your potential and stay committed to your trading journey. Each step you take brings you closer to your goals. Finally, it tapped our demand area. Notice how the buy-side liquidity is there, which I have highlighted on the red path. Liquidity acts like a magnet. Price always aims to target liquidity, so the liquidity is still sitting there, and it will be taken out. As you can see, the market has moved up from our perfect demand area through a perfect correction phase, targeting the perfect liquidity sitting above. Watch how it broke the high, or we can say higher high. This is how liquidity works in the live market. It's not just about learning liquidity. Our strategy involves combining everything we learn in all the sessions on the supply and demand strategy. Stay patient, and we will bring it all together in the final session. Let us jump into the 3-hour time frame. We will go to the lower time frame to show you more liquidity within the big zone. By just zooming into the 3-hour time frame, I have found the double top liquidity, or we can say equal highs, as I showed you in the diagram session. I've highlighted the low where the market started its upward move with yellow, and I've also highlighted the high with the same color at the top. We have a nice break in structure to the upside. See the line I have highlighted as the low of the zone and the double top liquidity at the top, which is our target. By drawing the Fibonacci retracement from our low to high, we can identify the best buying area, or demand zone, which we consider our best discount zone. After drawing the demand zone, I highlighted the high with yellow to make it easier to recognize on the chart. Now, observe how I highlight the path where the price has respected our demand zone and how it eventually broke the high to the upside. Now that we have identified the liquidity, demand zone, supply zone, and using Fibonacci to pinpoint best premium and discount zones, remember that liquidity is the key path the market follows. Let's see how this looks on the daily time frame and compare it to what we did on the 3-hour time frame. Remember, success doesn't come from what you do occasionally, it comes from what you do consistently. Stay focused and keep refining your skills. Now, by focusing on the chart, we can see that the market has dropped nicely with a clear break in structure to the downside. As you can see, I have marked the recent low on the chart and highlighted the high at the top. Notice how I marked the order block candle or supply area from where the market has dropped. Pay attention to the trendline liquidity on the upward move and on the downward move, as I have encircled both liquidity areas in red. Now, see how I marked the path where the market will move down to create a double bottom or equal lows, indicating liquidity to the downside. Then it will come up again, as shown in the path. The double bottom or equal lows give us more confidence to enter sells because the market needs to break the equal low liquidity below, as I have marked. The arrow I highlighted shows that the market needs to fill those imbalances as well. See, now the market dropped from our supply area and broke all the liquidity to the downside. This is how it looks on the daily time frame. Remember, the goal of a successful trader is to make the best trades. Money is secondary. Keep focusing on your strategy and stay disciplined. Now jumping to the lower time frame, the 4-hour time frame, this is how it looks. By zooming into the 4-hour time frame, I have found a beautiful example of equal lows, or we can say a double bottom. See the liquidity in the form of equal lows that I highlighted below. Notice how I marked the highs and lows with yellow color. By simply placing the Fibonacci retracement from high to low, we are looking for the best selling area in our premium area. After drawing the supply zone, you can see the nice break in structure to the downside. By highlighting the path with blue, I'm showing you how the market moved from high to low, then up and down again to create the double bottom. After that, it came up and then fell from the demand area to clear all the liquidity to the downside. This is how liquidity works in the market. This was on our lower time frame. As we go to even lower time frames, we can see more liquidity areas within the big structures. This is on the daily time frame. So, yeah guys, just practice and train your eyes. It's like going to the gym. If you want to be successful, you need to put in some hard work in this game. Now you know how to play it. That's all for the liquidity concepts. I hope you have a lot of fun with this. See you at the next session, where we will cover entries. Bye. Welcome back, guys, to the almost last session of the whole course. Today, we're diving into entries. We're going to discuss how to enter the market and explore different entry styles. This section is designed for everyone, whether you have a job or work 9 to 5 and can't be on the charts, or if you are sitting in front of the charts and executing manually. It is for everyone. Let us take a bullish example. The market is making higher highs and higher lows. That means we have our demand here. This is our first entry style, buying from the top of the demand zone. Place your stop loss a little bit below the demand area and set your take profit at the recent high. The market will move slowly through the correction phase, tap into the demand zone where we buy, and then the market will go up. Now let us take a bearish example. The market is making lower lows and lower highs. That means we have our supply zone here. This is our first entry style, selling from the premium area of the supply zone. Place your stop loss a little bit above the supply area and set your take profit at the recent low. The market will move slowly through the correction phase, tap into the supply zone where we sell, and then the market will drop. Just like we buy in the discount area of the demand zone, we sell in the premium area of the supply zone. As you've seen with price ranges earlier, it's the same principle. The second type of entry is at 50% of the demand or supply zone. We just need to place a GAN box in the demand area, and our entry will be at the 50% mark of the box. The stop loss should be placed slightly below the demand zone. This was a bullish example. Now let's look at a bearish example. It's the same process. We just need to place a GAN box in the supply area, and our entry will be at the 50% mark of the box. The stop loss should be placed slightly above the supply zone. And the third type of entry, honestly, this is the best one, is called the confirmation entry. Look, if the daily time frame is in a bullish trend, imagine that the blue line represents the daily trend, and the red line represents the 4-hour time frame. We need to wait for the daily time frame candle to come back to our demand area. When it taps into our demand area, we then wait for a break of structure on the 4-hour time frame. After the market breaks the structure on the 4-hour time frame, we will have another demand area. The market will need to pull back to our 4-hour demand zone and then go up. Our entry for buys will be at this new demand zone. With this entry type, we will get a higher risk to reward ratio, which is why it is the best. Similarly, if the daily time frame is in a bearish trend, imagine that the blue line represents the daily trend and the red line represents the 4-hour time frame. We need to wait for the daily time frame candle to come back to our supply area. When it taps into our supply area, we then wait for a break of structure on the 4-hour time frame. After the market breaks the structure on the 4-hour time frame, we will have another supply area. The market will need to pull back to our 4-hour supply zone and then fall to downside. Our entry for sells will be at this new supply zone. With this entry type, we will get a higher risk to reward ratio, now using confirmation with liquidity. When the price makes lower lows and lower highs, there will be a higher time frame supply zone here. So, when the market moves up to the supply area but doesn't quite tap the supply zone, it starts moving sideways. As we know from the liquidity concepts, we have liquidity sitting above and below this consolidation. We have to wait patiently until the market taps our supply zone. Then, we need a break of structure to the downside on the 4-hour time frame. After this break of structure to the downside, the market will pull back to the new lower time frame supply zone and then fall aggressively. Another example, when the price is moving down, creating lower lows and lower highs, and there is a higher time frame supply area or POI, whatever you call it. The price starts coming up, and suddenly, in the middle, the market will create double top liquidity with trendline liquidity below that. After forming the double top liquidity, the market dips slightly and then rises directly to the supply area before falling down, and then falls aggressively. Again, now the market is making higher highs and higher lows. We have a higher time frame demand zone here. As the price comes back, we need to wait patiently. When the price gets close to the demand area, it creates a triple bottom just above the demand zone and then a trap break in structure to the upside. Then it suddenly takes off the liquidity sitting below and then taps into the demand zone and moves up strongly. Now, as you can see, the market is making higher highs and higher lows, and we have our demand zone here. The price is pulling back down but hasn't reached the zone yet. The market starts moving sideways in the middle. We just need to wait patiently for it to tap into our demand zone. We will not enter until it taps into demand. The market might break the structure to the upside, which is a trap for early buyers. Then, the market will drop to our demand, taking the liquidity, and then market taps into our demand. Then it starts a huge upward move. Put your alerts on TradingView and just wait for the market to come to your demand or supply zones. You make money by just sitting and being patient. Trust me, you don't make money by trading every day. It's about analyzing the chart, marking your zones, and then waiting until the price reaches your zone. Let the market do whatever it will. Don't let it build liquidity. Let it build anything. You only focus on your zones and wait until the price comes to your zone. So, this was just on diagrams. In the next video, I will show you chart examples. Rewatch all the videos. Best of luck. Bye. Welcome back to the next video of the session on entries. In the last video, we covered diagrams. Now, we will jump to the charts. Let's dive into the XAU-USD chart. Let us focus on this recent move to the upside. See how I mark the highs and lows with yellow color? We have a beautiful break-in structure to the upside with huge imbalances. I've highlighted the low of our zone and the high of our zone, as you can see on the chart. Now let's draw the Fibonacci from low to high to find the best discount zone or demand zone, as we are on the weekly time frame. Now, let's zoom into the daily time frame to find an order block candle, or we can say a small demand zone, because on the weekly time frame, the zone is quite large. See the order block candle I encircled with red? After that, the market has moved up. Notice how I put the demand area on this little order block candle. By doing this, we can decrease our risk and increase our risk to reward ratio. Now, we will just wait for the market to come to our demand area. This is where we will buy, put our take profit at the high, and set our stop loss a little bit below the demand area. This trade offers about a 110 risk to reward ratio, which is the best. See how the market tapped into our demand area and then started the upward move towards our take profit. Remember, the only limit to our realization of tomorrow is our doubts of today. Keep believing in your strategy and stay focused on your goals. This is how it looks on the weekly time frame. It's simple to see here, just a few candles moving up from our demand zone. Look at the 4-hour time frame. See how messy and large the number of candles is here. This highlights the recent break in structure and the huge move up. We are waiting for the market to come back to the demand area, and then we will enter a buy position at our demand zone and target the high or more. And remember, this strategy works on every time frame. As you have learned in market structure, practice these concepts on every time frame and grind hard. Now let us take another bullish example here in the area highlighted on the chart. Let's zoom into it and encircle the high and low with yellow. See how I highlighted the high and low. Now, simply as you know, by placing the Fibonacci from low to high, we can find our demand area as you can see on the chart. After drawing the demand zone, notice how the market has broken the structure to the upside. See how the market tapped into our demand zone. Let us highlight or encircle this low also with yellow. Notice how the market has created another high below the recent high as liquidity. By placing the Fibonacci from low to high again, we found another demand area for buys. Now we have to wait for the market to tap our demand area and then fly higher, breaking the highs. Now the market has tapped into our new demand area, as you can see on the chart. Watch how the market will go up from here. This way of trading supply and demand entries is so simple to trade. It just needs practice to master this easy strategy. Remember, every expert was once a beginner. Stay dedicated, keep learning, and you'll see the rewards of your hard work. This is how it looks on the 4-hour time frame. These were the bullish examples. It is not just about finding supply and demand areas. After identifying these areas, we need to see if there is liquidity sitting there that we can target, as you learned in the liquidity concepts. You need to combine everything you have learned in all the videos in the FX Academy. Now let us jump into the bearish example on the XAG USD daily chart. First, let us mark the highs and lows with the same color. Look at the break of structure to the upside, and then the break of structure to the downside, indicating that the market has changed its trend from bullish to bearish. Now let us highlight the high and low of our zone. By highlighting the high and low, let us put our Fibonacci from high to low to find the best supply area to sell. See the liquidity sitting below the supply area? We just need to wait patiently for the market to reach our supply area through the correction phase and grab the liquidity below the supply area. Look at the path in blue. The market will act the same as shown by the blue path. Now, it is time to wait patiently until the market comes and taps into the supply area. See how the market has entered the supply area and took the liquidity. After tapping into the supply area, see how the market will melt and go down to target the low. This is how to enter in the sell scenario. Remember, consistency and dedication are the keys to mastering trading. Keep learning, keep practicing, and success will come your way. This is how it looks on the 4-hour time frame. Notice how it looks clear and clean on the daily time frame as I showed you. Focus on higher time frames like weekly and daily highs and lows because these zones are stronger and more important. For making precise entries, use lower time frames like the 1-hour, 2-hour, or 4-hour charts. These give you more detail and help you find the best points to enter trades. By combining these with the higher time frames, you can make better trading decisions. Let us jump into one more bearish example on the AUD/USD daily time frame. We can see a break in structure to the upside, followed by a sudden break of structure to the downside, indicating that the market shifted from a bullish to a bearish trend. Now, let us mark the highs and lows with the same color and observe the double bottom liquidity below, as I've highlighted on the chart. Notice how I've marked the high and low and the extreme low below. By putting the Fibonacci from high to low, we can find the best premium area or supply area. Notice how the market tapped into our supply area. See how the market is moving aggressively down to break the lows? These lows also represent liquidity and will be our targets. The market broke these lows with force, as you can see on the chart. This shows how supply and demand zones are respected across different time frames. It's all about practice. Keep practicing on TradingView, work with every time frame, and gain experience by observing what's happening in the market. Look at how it looks on the 4-hour time frame. I've found another supply area inside the 4-hour zone. Let us remove these diagrams from the chart and zoom into the 4-hour time frame. See how I've marked the high on the chart and then the low, which is our first target. Observe the break in structure to the downside. Notice how I applied the Fibonacci from high to low and marked the supply area. The market came, gave a small wick into it, and then dropped sharply to the downside. This is what we call a sniper entry. After identifying this, we can target the daily low as a swing trade and wait until it hits our final take profit or the last low. This is how to trade or how to do entries on supply and demand zones, whether on lower time frames or higher time frames. The same principles apply to every time frame. You just need to practice. Remember, the smaller the time frame you trade, the lower the probability. Conversely, trading on higher time frames generally offers higher probability trades. I wish you a lot of fun with all the content and much success in your trading journey. Practice on live charts, and best of luck putting it all together. We have learned about market structures, price ranges, price inefficiency and imbalances, supply and demand zones, liquidity concepts, and entries. Now, it's time to combine all these elements. Now I will just show you some examples, or we can say, how to combine all these things in a simple manner. Let us dive into the charts on the EUR-JPY daily time frame. See how the market has moved up, encircled on the chart, and notice the break in structure to the upside. I am highlighting the high and low of our zone, encircling them to make it simple and easier for your eyes. Now, observe the break in structure to the downside after the last high at the top. See how I highlighted the supply area on the order block candle before the downward move started. After the recent break in structure to the downside, the market pulled back to our supply area. Let me show you how to trade this. See on the chart how I placed my stop loss a little bit above the supply area and set my take profit at the low, targeting all the liquidity sitting as trendline liquidity. We have a huge move to the downside, a break in structure to the downside, the best supply zone, and liquidity to target all the way down to the low of our zone. See how the market moved aggressively after tapping into the supply area. You have to do the same and apply the same method every time. This is an easy 1:10 RR trade, which is the best risk to reward ratio. Stay focused and concentrate on everything you have learned. This is how it looks on the 4-hour time frame. However, I will dive into the 1-hour time frame now and show you how to trade and find exact 1-hour supply zones where we can get 1:21 RR and 1:29 RR trades, which is the best risk to reward ratio in the whole Forex industry. People usually take 1:2 RR or 1:3 RR trades. I will show you how to take 1:21 and 1:29 RR. Or you guys can catch even more after mastering this strategy. Now let us zoom into the 1-hour time frame by removing this diagram. After the market has touched the daily supply or higher time frame supply area, see here I have found a break in structure to the downside. Here we have the low and another break in structure to the downside. Let us highlight this particular area to make it look better and simple to focus on. See the highs and lows encircled with yellow. Notice how I highlighted the high and put the Fibonacci from high to low, marking the 1-hour supply zone. See how the market has tapped and dropped all the way down to the daily low, swing low, or simply to our take profit level. This trade is about a 1:21 risk to reward trade. Look how simple it looks, risking 1% and gaining 21%. Now, by focusing on another entry after the first entry, see the high I highlighted and another low as I marked and encircled with yellow. Again, by just putting the Fibonacci from high to low and highlighting another supply area, see how the market tapped into this supply area and melted all the way down to our take profit. This trade is about a 1:29 risk to reward trade, and another is a 1:21 risk to reward. In this trade, we are risking 1% and gaining 29%. These entries are also called sniper entries. This is how to catch the big moves. Remember, trading is a journey of continuous learning and practice. Patience, discipline, and hard work are the keys to success. Stay focused, trust your analysis, and never stop improving. Great things take time, and your dedication will pay off. Keep pushing forward and achieve your trading goals. See how these entries look on the daily time frame. We first have to look for the trend, then observe the huge move up or down, or what we can call imbalances. Next, we need to look for a break of structure to the upside or downside. After that, we have to mark the liquidity which we will target. This is what we need to see whenever we are going to buy or sell. Use this simple method and see how easy trading can be. This was a bearish example. Keep practicing and pushing forward. Don't make trading complex. Let it be simple, not easy. Simplify your strategy, trust your analysis, and stay disciplined. Your dedication will lead you to success. Now moving to another example on the USD chart on the daily time frame. Focus on the zone I have highlighted. See the highs and lows encircled with yellow and notice the clear break of structure with huge imbalance. Now, by highlighting the high and low of our zone, we can proceed as usual by placing the Fibonacci from our low to high. See the perfect buying area I marked? That's our perfect demand area. Now I will just wait for the market to tap into our demand zone. I'll put my stop loss below the demand and my take profit at the high. See how the market has tapped into our perfect demand area? Now the market will move to the upside to target the high, or we can say liquidity. This is how to trade simple and smart. Supply and demand zones are respected every time and in every time frame. You need a lot of practice to master this. You need a break in structure, and you need a huge move, or we can say imbalances and highs and lows. Identify the order block candle, also known as demand or supply zones, and you need liquidity to target. That is all you need. Just practice it as much as you can. See how it looks on the 4-hour time frame. Just practice it many times and master the simplest strategy: supply and demand. Success in trading is not about predicting the market. It's about staying disciplined, patient, and committed to your strategy. Every trade is a step towards mastering the art of the market. Now, let's move to the last example on the GBP USD daily chart. You can see a recent break in the structure to the downside. I've circled the important highs and lows in yellow to make them easy to spot. Next, focus on the high and low of our zone. These are key levels that will help us understand where the market might turn, so we can make better trading decisions. Now, by simply placing our Fibonacci tool from the recent high to the recent low, you can see the supply area that appears between the 79% and 100% levels of our premium zone. See how the market touches our supply area? We would sell there, placing our stop loss just a little above the supply area and setting our take profit at the recent low. Notice how the market created liquidity to trap retail traders into buying. For us, this is a signal that the market is likely to drop. Now, watch how the market falls down to our take profit level. If you take a close look at the zone, you can clearly see the order block candle where the downward move began. This is a great spot to make a high risk to reward trade. Look at the market's path. First, it moved down to create a lower low, then it went up to form a lower high. Next, it moved down again, breaking the structure to the downside. It then entered the supply area, created a double bottom liquidity, and finally fell down to our target low. This is how we trade the supply and demand strategy in a simple way. It really is quite straightforward. By combining all the concepts like market structure, price range, price inefficiency and imbalances, liquidity, and entry strategies, it's like reading a book and then summarizing the story or moral at the end. If you hit your stop losses, review where you went wrong and practice more. Make a checklist of everything I've covered in these videos. And remember, higher time frames and market structures are key. I hope you enjoyed the videos and found them helpful. I wish you a lot of success. That was the last part, putting it all together. I will be updating you with case studies and charts in the future for further learning. For now, thanks for watching, and I can't wait to see your success. See you next time.